Still with me in the studio, David Zidel, Senior Lecturer at Wits Business School. He's in to try and teach us how we look and garner information from income statements and balance sheets. It came about as a result of Tuesday. I was sitting in the pub reading the Business Day, as I usually do, and I saw these results for Harmony. And I started looking at them and I thought, okay, I don't know what's going on here. So we got out of David and said, come into the studio and explain to us. So the Board of Directors of Harmony, we're discussing you this evening. Right, we've done the income statement. Let's go on to the balance sheet. What does this tell us, David?
Okay, all the balance sheet tells you is where did the money come from and what do we do with the money. That's all a balance sheet does.
Okay.
And therefore, it has the name balance because it has to balance, it has to equal. Where did the money come from and where did it go to? So if we take a basics, let's take it from a business that is starting from scratch. They could go and borrow money from a bank, or if it's your business, you can put some money in it, or you can get investors. All those things is where the money comes from. What did you do with that money? Well, I kept some of it in the bank as cash, and that's an asset. Or I bought some equipment, etc.
Yeah.
And then I started trading, and then I owe people money, and people owe me money. The balance sheet keeps track of what that is.
Okay.
On the top half of your balance sheet,
Yes.
you can see it says assets, and it's just broken into non-current assets and current assets. That's
What is a non-current asset?
Okay, we're going to I'll come to that in a second. I want to actually start on the other half, if you don't mind, with the equity and liabilities. When I said you can get your money from your own investment or from shareholders, that is what we call equity. Equity is a liability because you owe it back to whoever gave you the money.
Yeah,
So where it says equity and liabilities, it's saying liabilities and liabilities, but breaking it into two types.
Okay.
Two key types of liabilities. There are two main differences. The one is equity and the other is debt. The key difference between them is debt is something you borrow and you pay interest on it. Equity is money that is invested in the business and you share in the profits of the business.
That
So
comes back to the income statement.
That
where
comes back to the income statement.
how much money you're going to give to your shareholders to keep them happy.
Correct.
Okay.
And you get, if the company doesn't make any money, you don't make any money. But if they make lots, you make lots.
Okay.
But just to the note from previously where we spoke about, the money that flows through that they reinvest into the business is under that one line that says retained earnings. So if you have a look under
Where is
share
that?
capital,
Yeah.
we're looking under the second half,
retained earnings.
equity and liabilities, share capital and reserves. You've got share capital, that's the money that they got when they first sold the shares.
Right.
Then you've got other reserves, and then you've got retained earnings. And retained earnings is the money that's been reinvested in the business over time.
Okay.
If
But
you
that is a liability because it is still owing to the shareholder.
Correct. It's a liability from the company because one day if the company stops operating, they have to pay that back to whoever put the money in the business.
So that's the money. So if, for example, this quarter, well, not if, they did 74 cents per ordinary share. If they decide to only pay out 37 cents and retain half of it, then that money would go into the retained earnings
Correct.
of the. Okay, right,
Correct.
I get that. Cool.
Now, you asked a question with the assets. What's a non-current asset and a current asset?
Yeah.
Your assets are basically broken down into two parts. Have you heard of fixed assets? You've heard the term fixed assets before. Most people know fixed assets.
Yeah.
But if you look down here, there are no fixed assets.
Yeah.
The term non-current assets is the new name for fixed assets.
Why did they change it?
I think they thought it sounded better. Fixed assets feels like it was fixed to the ground. So you think buildings are fixed assets and maybe motor cars are not. But motor cars are also fixed assets.
Oh, so in other words, one of the things is something called restricted cash. So that's obviously cash that they have, but they can't
use
get their hands on at the moment. So that is a fixed asset, but people wouldn't think of it as a fixed asset if you just called them fixed assets because they think of structures.
Yeah.
Okay, right.
I mean, the change from current assets to non-current assets is the same as instead of calling me a male, you just say I'm a non-female. It's kind of just breaking it into two different categories.
Okay, no, you see,
Yeah.
hang on, whoa.
The problem with Jeremy is when you mention something like this, his mind goes somewhere else completely.
You don't have the advantage that I have because I've got this earpiece here and I've just heard the entire production room fall apart when you said I'm a non-female. But it's okay, it's a very good description. You guys can stop laughing now in the production room, okay? Stop it.
Jeremy, the non-current assets are assets that a company will have for longer than a year. So the distinction between non-current and current is just time-based and it's 1 year. So anything that a company has that they would normally have for longer than a year will be a non-current.
Okay.
Anything less than a year will be a current asset.
Okay, so inventories, for example, they are sitting on 943 million rands worth of inventories. That is obviously 943 rands worth of gold that they're sitting on, but they will sell that within this next year.
Correct.
Okay,
Correct.
cool.
And the interesting thing is people can say, but there's inventory this year and there was inventory last year and the year before. So why is it within a year? It's different inventory.
Yeah.
They're going to be selling this within the year.
Okay.
So
Which is not a bad thing because if you look at it once again, and I'm comparing the last quarter to this quarter, they're up from 902 million rands worth of inventory to 943 rands worth of inventory, and the gold price is up as well.
Right.
So they're looking good at this stage.
They're looking good.
Yeah.
A key thing within companies often is they try and keep their stock, which is another word for inventory, as low as possible.
Yeah.
Because they say it's a non-productive asset. You've got your money invested in there. What you want to do is sell that as quick as possible, get the money in, use that to produce more stock.
Okay.
So it is good on the one hand, not good on the other hand.
But now in this particular case, I don't know what the gold price was in September, but it was certainly not what it is now.
Correct.
So it's a good time for them to sell that as quickly as
good
possible.
time to sell it,
Yeah.
maybe produce more. They could, if they felt that this gold price was going to drop now they might say, let's hedge our books. Or if they feel not only it's going to drop, but they're comfortable that they can make a profit at these levels, then, and they can contain their costs, then they might hedge their book or part of their book.
Okay.
So that in case it drops, they're still keeping in that portion and making
a
a
certain
profit.
amount, right?
Because
Okay.
the biggest thing is if the gold price drops, your costs are still the same. And
Yeah,
big thing in mining is containing those costs because your sales price is kind of unknown.
Yeah. You're not determining your sales
You
price.
don't-
You can't turn
yeah.
to your customer and saying, we're doing a 7% increase this year.
Yes.
Yeah.
And most companies, you produce and whatever your cost is, you add on a markup and you sell it at that. Gold companies can't do that.
Okay. Okay, right. So there we now get then, with the non-current assets and the current assets, we get to total assets.
Yeah. So it's just your non-current plus your current gives you your total assets.
Okay. Then we go on to where you jumped forward to, and that's the equities and liabilities. Now, I suppose this is where you were talking the inflow, what you get in and what you've got. This is now the outflow. And
Yes, except the other way around. The outflow is that non-current assets and the current assets. That's where you put your money. So the outflow is, I've got this money, I'm buying plant and equipment, I'm buying all sorts of different
that's where the
assets.
money is being used.
That's where the money is being used.
Right. Now, this is equities. You see, yesterday, you've got to almost reverse your brain here, because if I look at equity and liabilities to me means
Correct.
the outflow, but it's actually the stuff that you've got here as
Yep.
opposed to the stuff that you're going to shift and sell.
Correct.
Okay.
Correct.
Share capital and reserves you've spoken
Share
about.
capital
They've
and
got other
reserves.
reserves. They've got retained earnings, which we discussed already. Then non-current liabilities. Now, I would imagine then you've got non-current liabilities and current liabilities. The current liabilities, once again, do they fit into the current assets where they would be liabilities that will be disposed of or paid off in this next year?
Correct. So your current
Yesterday,
is this year.
I'm getting this, eh?
You're brilliant.
I could become a lecturer at Wits Business School.
Absolutely.
Maybe not.
Your current is what's going to get paid off this year. Your non-current is where you've got a long-term liability, and long-term in finance is more than a year. Interesting, you look at share capital and retained earnings. That retained earnings of 897 is not just from this year, it's from all the previous years. So you might say, well, that's one number, but how do I know what makes up more detail to this? And often there's a number that's, if you look at the actual financial statements, it's not on here, but they will have a number which is the note to the financial statements.
Okay.
And what the note to the financial statements is it gives you a little bit more detail than what's shown here. But it still doesn't show you that much. I've heard the saying that financial statements are like a bikini. Now, I'm scared to mention that to you because
Yes,
you're mine.
okay. Yeah, okay.
But
It shows you a little bit, but you'd actually like to see a little bit more.
correct. It shows you what's interesting.
You're quite a dirty bugger. You know what? Sorry, when I introduced him, I said he was a lecturer. He's actually not. He's a lecturer. Okay, cool.
So it's exactly that. What they show you is interesting, but what's hidden is confidential to the company. So
But how can they keep stuff confidential from me? I'm a shareholder.
you're a shareholder, but you can't know exactly what's happening. You own the company because you own the shares,
Yeah.
but you can't get involved with the actual operations. And this way they're revealing what's happening, but it comes out a little bit later, it comes out a few months later. It's giving you the information that they need to give. But if you were a competing mine and you wanted to know everything
Okay.
about the company, you could
You would
go buy one share and then
And know everything.
know exactly what's
Okay.
happening. So there needs to be a level of confidentiality.
Right, so we've got the non-current liabilities and the current liabilities, and that gives us a total equity and liabilities and Blixen. Look at that. They're exactly the same number.
And it has to be the same because it's saying where did the money come from, where did it go, and
Balance.
hence the name,
The
the balance sheet. So it balances.
David, you know what? Even though you are filthy, you've got a filthy mind, you're very good at explaining things. You have effectively in half an hour taught me how to look at an income statement and a balance sheet. Thank you very much for